let's dive deep a little bit. Would you, and I guess you did mention it in your book, what do you think, or do you believe consolidating a portfolio using 1031 exchange is more powerful than diversifying? The reason behind that is I do have some clients who get uncomfortable putting all their eggs in one basket, right? What would be your recommendation based on your experience?
Great question. A lot of it is going to boil down to what the individual investor's comfort level really is and they're at in their own life cycle. You understand this really well. You're not the same investor today that you were yesterday,
No.
that you're going to be tomorrow.
Correct.
So our needs, our desires, our goals, and our abilities are all different wherever we're at.
Right.
And also at the same time, though, the real estate market changes as well.
True.
And the type of investing that works in one market doesn't work in another. What's making the type of real estate that's making the most returns in one part of a cycle isn't in another. So it really comes down to that. What I love about the 1031 exchange is it will let you do whatever the market is telling you, and it will let you react to wherever you are. So let's talk about that. I call him the accidental investor. This is really a prototype. We're getting married older and older in life now. Many times when we get married, I might have a house. My new spouse might have a house. Well, we're only going to live in one.
Right.
So what do? We turn the other one into a rental. And voila, we're real estate investors. And that's great. And a couple years later, we're going, we like those rent checks. What if we were to sell this property and go buy two?
Right.
And we'll use the 1031 exchange so we won't pay tax. A couple years later, we sell the two, we buy four. We sell four, we buy eight. We're having a great time until something happens, Patrick. I wake up one morning and I'm just tired. Why am I tired? Because I got 20 gajillion properties.
Yes.
And I'm on phone calls, and my life doesn't support that. That's when it's time to start consolidating and selling 4 or 5 properties for $100,000 each, and use them to go buy one $500,000 property.
That makes sense.
That's the ebb and the flow. Or you mentioned we talked about California in the first episode.
Right.
Regions, their taxes are.
Oh,
California is probably the single highest appreciation state that there is as well. So even though you don't make a lot of cash flow on your rental, the appreciation is usually huge.
Right. Usually, I get it.
Right. So round about 2014-ish, I had a ton of investors who were leaving San Francisco in the Bay Area, where property had just inflated incredibly. And they were all moving their portfolios following this guy named Elon to Austin, Texas.
Yep, I remember.
Dirt and dirt cheap properties. So they were taking high value properties, diversifying into large numbers of cheaper properties because they could take advantage of those inequities in the market.
Right.
So those are all good reasons to consolidate, to diversify. There also comes a time earlier rather than later where we start to realize that we've got some other priorities. We've started a young family and it's time to start building memories.
Yes.
So we will move into vacation rentals because we can not only generate income, but we also get to use them to build.
Right.
And for our higher net worth folks, there's an added bonus.
Okay.
Vacation short-term rentals can be treated as an active employment for purposes of depreciation.
Nice.
In other words, you get to deduct all of that in active participation.
Nice.
Short-term rental. It's not passive. Huge benefit for high net worth individuals. So those are all reasons why you might do that. Ultimately, though, as we get older and older, we've got more money and less energy. So moving from active to passive is really a key to keep interest going. I will probably invest in real estate all my life because I enjoy it so
Me,
much.
me too.
But you got a few more years, I can see.
I'm just saying that I'm admitting that I'm going to keep investing in real estate for the rest of my life, period.
Exactly. But I will admit, I'm at a stage where I
Mhm.
don't have nearly as much fun beating down walls and putting up drywall. So I'm
Yes.
looking more for the passive opportunities
Right.
because I can still use what I have learned to underwrite and evaluate real estate opportunities.
True.
That's almost as much
True.
fun.
True. It's interesting you talked about passive, right? It's two folds. We watch YouTube or the social media, invest in real estate for passive income. Oh, it's easy to get you the cash flow, right? You did touch on a few things, but I only want to focus on one, right? As a real estate investor, usually coming in, you think, oh, this is going to be passive income until you buy your first property and you realize, oh, no, there's nothing passive about this. So, my question is that truly a passive income in real estate? And any real estate investor who knows that, hey, my investment is not passive, it's actually active, how would they truly transition to passive? Leveraging 1031 exchange. And I know you also touch on this in your book. Can you educate us on that?
Right. So I would say that there's no investment in the world, real estate or otherwise, that's
Mhm.
truly passive.
Right.
Even if it doesn't take hands on, it's still going to keep you up at night thinking about it. So there's
Yes.
always going to be a
Yes.
level of active thought or
Involvement.
action,
You're
right?
right.
But you can determine the level of action that you have to have. That real estate where you're changing the toilets, fixing the light bulbs, collecting the rent, that's
Yep.
as active as it gets.
Yes.
You want to come one step down from that, you get to the point where you hire a property manager.
Yes.
Now, that is still not passive because
Nope.
you still have an employee, a
Yes.
property manager. So
Yep.
you're managing an employee and you're managing finance. Now, you can go one step further than that and buy into, say, a number of vacation rentals. And you have systems of automation, and you let companies like Vacasa, Verbo, Airbnb manage a bunch of the processes, but you've still got some activity that you
Yes.
have to do.
Right.
Now, you can go into something like a REIT, a real estate
Mhm.
investment trust.
Right.
But I got to caveat by saying that is not actual real estate. Is what
Nope.
it's not. It
Yes.
doesn't qualify for 1031 treatment because
Yep.
it's considered an equity and not real estate. So
Right.
you can't 1031 it. It's a stock, but it's a stock where the company buys real estate. So let's
Yes.
call it a real estate investment. Well, you don't get to manage it. You don't get to make decisions. You don't get to do anything about it. That's
Mhm.
pretty passive. But
Right.
you're watching the stock price every day to see when it's time to sell. You're
Right.
looking at their annual reports. So that's pretty passive, but not really. Triple net commercial investing is fairly passive because what you're doing is you're selling all those single family homes and
Mhm.
you're buying one large commercial property
Mhm.
where a national credit tenant like
Okay.
Verizon or some have Amazon paying all of the taxes, the insurance, and they're doing their own maintenance.
Right.
So you don't have to do any
Okay.
of the property itself.
Right.
The leases are typically 10 to 25 years.
Right.
So you're only managing basically a lease. That's
Yes.
pretty passive, entirely passive. Ask anybody that bought a Sears building a few years ago. Things happen. There's nothing that's truly passive, but you can
True.
control. Most of our clients, the most passive they will get is going to be going into triple net commercial called Delaware statutory trust. These are fractional ownership of one asset, not like a REIT where they own thousands of properties. DST owns an apartment complex in Baton Rouge, a medical center in San Francisco, Amazon distribution center in Chicago. And they own that and they manage it. But you are a passive investor as if you bought a REIT. But because
That
it's
makes
set up
sense.
with DST, it qualifies for 1031 treatment. This is what you get, the four components of the internal rate of return. Cash flow, the cash flow of the operation.
Mhm.
You get continued depreciation.
Right.
You get the amortization of the
Yes.
loan as the
Right.
tenant pays it off.
Mhm.
And you get your share of the appreciation.
Right.
Every 4 or 5 years, they're sold. It becomes a little active for you because you get to do a 1031 exchange. And you can either buy more or maybe interest rates drop back down to 2% again. So you decide to 1031 back into regular assets. Again, that ebb and flow of the 1031 exchange, where you could go active to passive to active, large
Mhm.
numbers, small numbers to large numbers,
Mhm.
anywhere in the country. And I don't think we've touched on this, but it's been inherent. Any type. So if you think single family homes are a bad investment and you want to buy multifamily, 1031 into them. If you want to move from multifamily into commercial,
Mhm.
1031. Any type of real estate at all.
You touch on